Hello, this is Brian Akers from Akers Financial Group, and we welcome you to the Akers Financial Group 2023 Mid-Year Market Review. I'll be speaking to begin and to end, but in the middle, we'll have Mark DiOrio. Mark DiOrio is Chief Investment Officer from Brookstone Capital Management, our third-party money manager out of Chicago. Brookstone Capital Management has been someone we've been working with for more than 10 years. Today's talk, we are going to start out with our disclosures. As investment advisors under Arcadios Wealth, we're through their RIA. We also are considered stockbrokers through Arcadios Capital, and we have licenses as life and health agents. So make sure you read our disclosures that we show on the screen. Today's talk is going to be talking about the 2023 stock market. There's lots of information out there on our website in case you want to check us out at akersfinancialgroup.com. On that website, you've seen our webinars tab. There's also a radio tab. It's Winning in Retirement, just like there it is, Winning in Retirement radio show. We're on 105.7 The Fan at 11 a.m. And recently in the last quarter, we started doing the show at 10 a.m. on 6:80 a.m. That's on WCBM on Saturday mornings. So feel free to tune in to either of those, or you can go to our podcasts, Winning in Retirement Podcast, and hear any of our past shows to learn and develop your knowledge of financial planning, and also to be able to understand how we work here at Akers Financial Group. We believe financial planning is an incredible way to start and a way to guide you through your financial decisions. But when we're trying to implement a plan, we truly need to manage that money well. And part of managing that money is managing money through the markets, the good and the bad. So properly implementing the plan that we draw up is what we're trying to do. And by having this mid-year review, we want to tell you what the market's been doing and what we think is going on now so that you understand everything. Feel free to ask any questions by giving us an email. You can email us at info@akersfinancialgroup.com. Just give us a call also at our main line if you'd like. Our website, akersfinancialgroup.com. I would like to introduce Mark DiOrio. He'll be coming up next. Hello, it's Brian Akers back with Mark DiOrio. Good morning, Mark.
Morning, Brian. Happy to be here.
I'm glad to have you here. I'm really glad to have you here in the mid-year of 2023 to go over the market review and give us a little forecast of the rest of the year. Mark is the Chief Investment Officer at Brookstone Capital Management. It's our third-party money manager that we use here at Akers Financial Group. He runs the bunch of different portfolios for us there, and they also work with most of the money that we have held at TD, which will become Charles Schwab here this fall. Mark DiOrio, I was going to just let you have the screen and let you go ahead and give us your talk for today. I appreciate that.
Great. Thanks, Brian. Let me pop up the screen, and I have a few slides to go over.
That'd be great. Thank you.
I trust everyone can see this and you can see this. So I'm just going to jump into the third quarter market outlook and review, as Brian mentioned, review a little bit of what's happened through the first half of the year. But I think it's important to preface this market outlook by where we were in the first quarter of 2023 or the end of 2022, which was the markets were on a very down and sour note. Both stocks and bonds had some of their worst years in recent memory. And there was a lot of pessimism coming into this year that we would be in a recession basically right when the calendar flipped to 2023. So all Wall Street strategists thought that the market would be down in the first half of the year and before starting some type of recovery in the second half of the year, and that we would have been going through a recession for most of this year. In our first quarter market outlook, we laid out the case why we thought that the market was actually set up for a surprise rally and that there would be no recession in the first 6 months of the year because the data didn't support it, but also because consumers continued to be strong. And remember that consumers are 2/3 of the economy. And when we measure the economy, it's by GDP or gross domestic product, and a recession is 2 negative quarters of GDP. But we thought with a strong jobs market and labor market and consumers being strong, you just weren't going to get that recession. And so without further bad news, you didn't need necessarily good news for the markets to rebound. What you needed was the news not to be as bad as the market expected. And sure enough, that's kind of what transpired in the first half of this year. And we got some good news in the sense that inflation was coming down, some economic surprises. earnings remain resilient in that environment. So in the dark blue here, you see the S&P 500, the broad gauge of stocks were up almost doubled or double digits in the first half of the year. But in the light blue there, the median stock was up about 4%, meaning over half the stocks in the S&P 500 were down less than 4 or up less than 4%, and a whole group of stocks actually have been negative year to date. So it's been really interesting, this big gap that's come up. So it's been a little bit trickier of a market, I would say, in this rally that's made a comeback here in this first part of the year than maybe the headline would suggest. And really that's due to the largest stocks in the S&P 500 having a big major rally and a big comeback after being down. And most of those are tech-related stocks. So this is really, we got the surprise rally that we thought on the heels of kind of continuing good news and economic surprises. But I would be mindful that now that's in the rearview mirror. As we go forward, you're not going to have those surprises going forward. The good news on inflation is mostly kind of baked in, or the market has already responded to the decline in inflation, which of course in 2022 was the problem where you had persistently high inflation as the Federal Reserve raised interest rates to try to bring inflation down. And so when the Federal Reserve raises interest rates, what they're trying to do is slow the economy down, making it a little more costly to borrow money. And when they slow the economy down, that usually has the effect of cooling down demand, which then cools down inflation. And so that's kind of been the policy throughout 2022 and even into 2023. But the good news has actually given the stocks and investors reasons to cheer and get a little bit more aggressive in the market. But I think it's really important to point out this dichotomy that you've had in the market, that it's not all stocks that are participating at the current moment in this first 6 months. There's a whole group that really haven't participated. But let me highlight what really has driven this market, almost relates to all the gains, is the 7 or the super 7 big tech-related stocks. Not all these stocks are technically in technology any longer, the technology sector any longer, because they've broken them out. For example, Amazon is consumer discretionary, Alphabet, formerly known as Google, is in communication services and so forth. So it's Apple, Microsoft, Alphabet, Google, Amazon, Tesla, Meta, NVIDIA, which some folks know that name now. It's a semiconductor player. But those 7 stocks represent 27% of the entire S&P 500. So it's very top heavy at the moment. And so you've had this, after they've had a very difficult 2022, they've had this roaring recovery in 2023 and led the market higher. So think about that. Just 7 stocks are representing a quarter of the entire index, and they've had outsized moves this year. So I think that's very interesting and very important when you think about investing going forward. We don't think it's necessarily going to be a replay when you extend the time frame out to 2, 3, 5 years. So you have to take that into account when you're building a portfolio, and how important these 7 stocks have been in this moment. And it could go on for a little bit longer, and tech in general has rallied and really led this market. But when we look going forward, what we want to do is think about the impact that the current market move has had on valuation. So when I say current market move, it's both on the growth stock, so all the way on the left-hand side. The diamond there shows you where the current valuation is, price to earnings ratios generally. So what price, what multiple is it's called. So if you earn $1 and the stock trades at $20, then that's a price to earnings multiple of 20. If you're paying 27 times or 28 times where technology is currently, or growth stocks are currently, that's well above their long-term average, and that's the shaded bar. And then the 10-year median is there, that dashed line in there. So growth stocks are trading well above kind of their average, the 80th to the 20th percentile, and well above the average. Where if you look at other types of stocks, other categories of stocks, so it's small cap, dividend growers, low volatility stocks, value stocks, mid caps, way below their historical average, and even high dividend stocks. And I think that's important. Dividend investing has been very important, I think, and is more and more important as you think about the income generation that dividends provide. and also the types of stocks that generate dividends, which are a little bit more conservative, and then growth stocks that are kind of developed business models that have excess cash, and they distribute that cash out to shareholders. So you get constant income from dividend payers. So dividends don't necessarily go out of fashion. They could go out of favor in the moment, but dividends are very persistent, and it's just a strategy that can go out of favor at the moment, and then well, especially when growth stocks are leading the market. But then as it rotates back, and maybe the growth stocks get extended valuation, or maybe the outlook isn't as good, or earnings surprise negatively, you can see a rotation back into something like dividend payers. So looking at it right now, you'd say, wow, those are really undervalued relative to where growth stocks are. So that doesn't tell you necessarily in the next week or 2 months where it's going to go, but it definitely tells you where you're at when you look at a cyclical horizon, 18 to 36 months. Well, where's the value at right now in the marketplace? Do I want to think about making a rotation, and have the right mindset of letting that rotation play out, letting the transition in the market play out? So this looks at multiple areas where there's a lot of opportunity in the market. It just shows you at the moment you have this kind of momentum rally in the big cap tech or growth stocks that have led the market, but they are extended in terms of a valuation side. So once that runs out, you can see that rotation, and it looks like there's simply a lot of opportunity in other areas in the market that just haven't participated year to date. And if as the rally broadens out, you'll start to see those participate. And from taking a few steps back, from a macro perspective, we look at not just stocks and the differentiation of the different asset classes or categories of stocks. I mentioned large cap, growth stocks, small cap stocks, dividend payers, low volatility, and so forth. We also look at stocks relative to bonds and cash, particularly the interest rate or coupon that they pay. And one thing that's been very interesting in the current market environment that hasn't been with us in a couple of decades, we've long said, in one of our secular or multi-business cycle themes for the last 8+ years has been that stocks are cheap relative to interest rates. So even though markets were rallying and having decent returns, we kept saying that stocks continue to be cheap relative to interest rates. So any sell-off could really be bought, thinking that you have valuation on your side because interest rates were so low. Well, today, that becomes a little bit of a challenging proposition as we go forward. That's no longer in the secular bullish case, because as this chart shows, basically the interest rates on both bonds and cash equivalents or short-term bonds are in that 5% range, very similar to what we'd call the earnings yield, or the inverse of the PE ratio. So if you have a PE of 20, price to earnings ratio of 20, you take the inverse of that, and it's 5%. So essentially what you're looking at is what's the earnings yield on stocks. And you can see that that medium blue line there is stocks, and it's clearly had a big gap between bonds, the darker blue, and then that gray line and mountain chart there with a cash equivalents. So this has important implications for asset allocation overall, and something we don't want to lose sight of, meaning that earnings really have to come through in order, and returns will have to be higher in stocks going forward to kind of justify the volatility that you get in stocks that you don't normally get, especially in cash equivalents, short-term investments, short-term bonds, as you do in longer-term bonds. So we're looking at this very closely, and I think depending on where interest rates go, that'll give us a really good sign of how we want to build that portfolio and where the opportunities are across the asset class landscape. And the reason they're so high, or the short-term interest rates are so high and competing with stocks is because you've had the Federal Reserve raise interest rates very quickly all the way to the right from a very low level. Remember, after the pandemic, they put interest rates to very low levels to hopefully stimulate the economy. And then as 2022 rolled around, you had inflation kind of as the cost of doing that, enacting that policy, start to get out of control, where they decided to make their primary objective getting inflation down. And to make sure everyone understands, the Federal Reserve essentially has two, and when they're making policy, they basically have two mandates. It's called a dual mandate. So one is to promote or have policies that promote full employment, and the other is to promote policies that encourage stable prices. So full employment, think of that as 5% unemployment rate, somewhere in there. Well, during COVID, when you had the pandemic and the shutdowns, you had unemployment spike. So their main goal was to get the employment or the labor market kind of back in gear. And the way to do that was to reduce interest rates and provide any stimulus efforts that they could to address that issue. They knew that by doing that, well, then we'd have to face the next risk, which was inflation. You just didn't know when it would manifest. And so as inflation or as unemployment went below 5% and continues to be below 4%, that problem is under control. So they moved over to the inflation risk, where you had inflation well above the Fed's target of 2% and hitting a 9% high in the third quarter of last year. And now it's come down closer into that, depending on which number you're looking at. Usually it's the CPI. You're in that 4% range. So it's definitely come in the right direction. It's just not down all the way to 2%. So the Federal Reserve raised interest rates very quickly to get to this level, to cool down demand and really address that inflation risk issue. Now, there's a risk to raising interest rates that they also know, which is generally what you have to do to kind of take out inflation is cause a recession. And so by raising interest rates, they clearly know that that's a risk to the economy, but it's a risk they're willing to take so that inflation doesn't get too far out of control. And you have something like the 1970s, where it was really challenging for a long period of time. They're trying to take care of it right now, and so that the longer term outlook on inflation is much better. So we have not lost sight of the issue as we're looking forward, that a few of the normal indicators that you look for a recession continue to argue that a recession is in the cards for the economy, even though you've had this nice rally in stocks overall. One of those is something called a yield curve inversion. I apologize for the term, but it's basically telling you is that short-term interest rates are higher than long-term interest rates. So in the Treasury market, and the Treasury bonds are usually what investors look at, and Treasuries are considered the risk-free rates because you'll get your principal back because it's issued by the US government, and it's what the government uses to pay the bills and for deficit spending and so forth. Short-term interest rates are about at 5.25%, and you have longer-term interest rates, the 10-year Treasury at about 3.75. So that gives you about 1.5% difference. So that's not normal, where you have longer rates below short-term rates for this long of period. The market can do it briefly, but this causes real pain in the normal operating system of a bank, for example, where they collect deposits, pay a couple of percent, and then lend out at a higher interest rate. So that's how they make their net interest margin. But the point is, this characteristic or this condition in the market has basically indicated a recession at a very high clip here. And there's a number of circles on this chart right before the gray bars, which are recessions. Another one is leading economic indicators. And what this shows is that we've had a consistent downtrend in leading economic indicators. You can think of those as future purchases and expectations for purchases, and what the market expects going forward, and some of the internals in there. And so that's really shown also at a high degree of predictability in terms of indicating a recession. So clearly we're at recession potential levels in the leading economic indicators, Treasury yield curve. So all these classic signs are really, really there. There's been one caveat that we think has been very strong and was really a big reason why we thought that there wasn't going to be a recession, definitely not in the first 6 months of 2023, was that there was excess savings in the economy from stimulus efforts. And so when you have excess savings, the question is, well, are consumers going to save that, or are they going to spend that? And what we saw was that consumers have been spending down this excess savings. And so that excess savings from those stimulus efforts will probably run out at the end of 2023. So right about there. And so that's probably enough to keep the economy out of recession through 2023. But just when you think that the recession is gone and we've passed that challenge, that's when it gets a little trickier, because as I mentioned, the excess savings will be gone and you're still with a little bit elevated prices. Even if inflation has come down, that means it's come down in terms of the pace of the increase in prices. And so there's still some dislocations out there. They're much, much better, but now you've pulled forward some demand. And we think that that's a risk when we look out into 2024, so that the market will start to anticipate it at some point, usually 6 months before the official recession. But we've not lost kind of our risk mindset, in that the recession risk hasn't gone away. We want to be mindful when we build portfolios. We want to be aware of the interest rate environment. We want to be aware of the valuation in different types of stocks, because those that are maybe overvalued relative to their historical ranges are a little bit more at risk than those that are trading undervalued or reasonably valued relative to their historical norms. This is a chart that we put out in the first quarter market outlook that is a cycle composite for 2023. That's the blue line here. And what it argued for was a rally in essentially the first 6 months of the year. And it was, what it does is put together the 1 year, the 4-year presidential cycle, and the 10-year cycle. And it gives you kind of a composite expectation for the year. Now, I mentioned the 4-year presidential cycle. Historically, the 3rd year of the presidential cycle, which this is, has been the strongest of the 4 years. And so with that backdrop, that also aided kind of a historical precedent to kind of our outlook that, well, if there's no recession, historically, this has been a stronger portion of the year. Why? Usually fiscal spending comes in. There isn't as a hostile a monetary environment at that time, and the Fed has not raised as aggressively as they did in 2022. In fact, they recently paused. And so that kind of led to this surprise rally. And this year, the orange dotted line here, it's really followed this path very, very well. And looking out, this gives us a pretty good expectation for the second half of the year. I think there's a few more challenges where there's not as many positive surprises as there would be when the market's already sold off. The markets are already kind of anticipated good news and rallied in anticipation of that. And it also received good news on inflation. From here, it might not be enough to have a little bit of good news to move the markets that much forward. And looking at this objective data, I would say maybe have a pause in the rally in the 3rd quarter at some point, maybe some sideways action as the market tries to figure out, what does 2024 look like? Valuations in certain areas of the market are a little bit high. And then in other areas, well, it might worry about a potential recession in 2024. But either way, it does show that the market can hold those levels relatively well into year end. So this is a very, very interesting chart. And the way it's followed it this year gives us a pretty good path and sets an expectation in the second half of the year. And so very different than what Wall Street strategists and forecasters had at the beginning of the year. But this is our objective data, looking at history as a guide, and then validation with some of the current data that we're looking at. So this is our base case into the second half of the year, where you may have hold up. You may see some other stocks start to participate and hold up the general indexes, while some of those larger stocks may have had their runs already. And so we may see some value players come in and actually balance out this market, and some different players that in different stocks that have actually sold off in the front part of the year, catch a bid here and kind of catch up to the rally. So so I think it's going to be an exciting time in the second half of the year, but also it's an important piece of the puzzle as we start to look at 2024 as well, because I think that we don't want to lose sight of where we're at in the market cycle. But those are some of the kind of review of first 6 months of 2023, and also our outlook for back half of 2023. Brian, if you want to jump back in, I'd be happy
yeah.
to.
Thank you very much, Mark. So I was trying to figure out just simply good or bad news. What would you call your forecast there?
Well, I think it's actually somewhat good news in the sense that we've faced a lot of risks. The inflation risk, we've had geopolitical risks, we've had a mini banking crisis in the first half, and the market's been able to overcome all of those. And of course, the recession risk that just doesn't seem like it's going to pop up in 2023. And so you have a market that can sustain its levels, even if you have some sideways actions. And in addition, you also have stocks that haven't participated that I think actually look pretty cheap right here, both short term and longer term. So I think there's a lot of opportunity if you're willing to look across the asset class landscape. And I know there's the Super 7 get all the media attention and headlines because it's exciting and what they're doing is exciting. There's a lot of stocks that I think look pretty appealing here for longer term investors for sure.
Sounds like diversification might actually work well the next 6 to 12 months, right?
I definitely think so. It's a different landscape than we've seen. Well, you might say 2 decades.
Well,
where
it's been a lot of the certain stocks taking a ride really fast, and everybody else just sort of drags along at a lot slower pace. But a lot of those companies have great profits, great cash, and they're good stocks to buy, and would be great stocks to hold long term. So it's an interesting time to have people buy for the long term, especially with cash is no longer trash. You can actually make interest there. I guess your forecast would show us that interest rates actually might go down over the next 12 months a little bit.
So we'd expect them to come down as the economy slows down, as the effect of interest rates actually slows down the economy and spending starts to come down as stimulus runs off. So we would see interest rates come down really in the long end first, and then the shorter end will start to come down. The Federal Reserve will likely start to reduce rates in 2024. So this is a phenomenon, like you mentioned, 6 to 12 months in terms of where we're at on the interest rate scale, and to contemplate what that would mean if interest rates were going down. And so we definitely think that that's a likely possibility, given that they're higher than they've been in quite some time as well. So some investors will look at that and say, well, especially pension funds, things like that, will say, well, this is the best we've seen in many years. We might
almost
as well.
a decade, I think. All right,
sure.
So Mark, we have you coming in on October 13th for our Winning in Retirement Training Day. So we look forward to seeing you then and getting another update from you. So thank you very much for your market update and forecast, Mark DiOrio. Thank you very much, sir.
Great. Thanks, Brian.
All right, have a good day.
You too.
I'd like to thank Mark DiOrio for the mid-year review of the markets. The pretty excellent information for us to learn about what's going on and some thoughts about the near-term future, which we need to consider. Now, at Akers Financial Group, we do work through Brookstone Capital Management as a third-party money manager. This is a fee-based money management where we're actively trading the accounts. Mark DiOrio manages certain portfolios, and he also helps manage portfolios that we assist in. Our investment committee gets together every Monday to build our AFG Select models. So just for a couple of minutes, I'd like to cover a little bit about the AFG Select models as we finish our talk for today. So I'm going to go ahead and share a screen and show you a little bit about what I mean. So Akers Financial Group AFG Select models, we have an income portfolio designed for those seeking income. And we divide it into different asset classes using ETFs, mutual funds. We also have a moderate portfolio, more designed as a core holding for people to be able to have money invested over the long term. And then we have our moderate aggressive portfolio, which is a little bit longer term design, where we have our portfolio designed in the technology, also into silver and gold commodities, US passively and actively invested. And then we have our fourth portfolio called Diversifier, where we buy international mutual funds and ETFs, along with silver, gold, and commodities, and a little bit in real estate for those portfolios. Year to date, our Diversifier portfolio is up 1.84%. Our income portfolio is up 6.35%. Moderate's up 8.74%, and our moderate aggressive around 11.27% as we've seen the market recover. We've been managing money in these styles through Brookstone Capital Management since 2017. Well, that was a quick review and a sheet that I brought up. If you'd like a copy of that, just email us at info@akersfinancial.com, or you can give us a call and we can send that to you about what we're doing right now with the money management when we build our core and satellite portfolios like that Mark had mentioned earlier. Markets go up and down. At Akers Financial Group, we build portfolios that have actively managed where we take risk, and we have money invested for protection. Layering those out have led us to many, many ideas, especially for 2023, that involve some guaranteed interest. So the use of CDs, treasury bills, fixed and fixed index annuities have allowed us to build portfolios that can make over 5% with no downside risk in these types of vehicles, 5+ with and protected, which is a great way not to be in the bond market, to be in bond mutual funds where you might suffer downside like in 2022. So our models at Akers Financial Group, we truly have our active portfolios. We layer that in with our protected side. As we all know, as we get closer to retirement years, we need to have less risk. We need our money to be there, our money to last a lifetime. So this mid-year market review is what are we doing right now? Those are some ideas of what we're doing right now. Akers Financial Group is looking forward to planning our October 13th event. We're going to call it Training Day. Winning in Retirement is our radio show, but we want to come out with an event called Winning in Retirement Training Day, training how you can be winning in your retirement years. As you prepare to win, that's built for younger clients under 50 years old. Also invite those that are not clients. People that are over 50 but not yet retired, we'll call that Are You Ready to Retire? Segment of our training day, October 13th, begins a little bit afternoon. First class at 1 o'clock, runs around 6:30 that night on October the 13th. We'll also have our third set of classes called Keep Retired, keep on winning. Have that people that are retired and how we manage the money to give us the pay raises we need through this inflationary environment. And then the fourth track that we're going to have on Training Day, October 13th, 2023, we're going to have this track called the Ultra Track. That track is for ideas to maximize wealth and wealth investment and wealth planning. Ideas that really, really matter most to building your wealth over time. We'll also have some extra classes on our Black Diamond website where you can go directly there and see your accounts you have with us anytime. We'll teach you how to use it that day. And also have some real estate agent there, along with many speakers from around the country. We look forward to having you there in October 13th. Yes, it's Friday the 13th, but we don't want investments to be about luck or good luck or bad luck. We're going to have a good day that Friday. We do have some special singers, and we look forward to having you there October 13th. Give us a call and sign up, but make sure you save that date. All right, so our mid-year review is coming to a close here. We welcome you to listen to our radio show, Winning in Retirement. Call us with any questions you have. Be careful to read our emails every Wednesday that announce all kinds of events we have planned for the later summer and the rest of this fall. Feel free to come and invite your friends anytime. As we close, I do thank you for being our clients, or thank you for spending time with us and understanding about investments that we've put together for our clients. Understand that we do appreciate that greatly. At Akers Financial Group, we grow because you grow with us, and we thank you very much for all that. I'm Brian Akers, and I thank you for this. We always wish you the best in winning in your own retirement years. Take care.